generate codes and human-like responses through text, write stories, and do a lot more.
I work in a newsroom with anchors, researchers and scriptwriters, graphic artists, producers, video editors, camera crew. But does a newsroom really need them today?
All of us have to think about unique and distinctive value addition that cannot be automated or repeated or replaced by a machine.
ChatGPT may kill many companies.
A human has to be in the loop with an ability to control this.
Dark Side of the Boom. Streaming now.
Hello and a very warm welcome. You're watching News 9. I'm Shweta Kothari. We are bringing you stories from the world of business, policy and economy. To my left is my colleague Suyash Maheshwari. Suyash, let's quickly run our viewers through markets this afternoon.
Certainly. So after opening in the green, Indian markets continued to build on the bullish momentum throughout the session, and in the intraday trade, the Nifty and the Sensex surged as much as 1%, with Sensex able to claim back the 19,700 mark. However, it could not sustain above those levels because we saw some selling pressure taking place in the last 1 hour of the trade, and as a result, the index Nifty index fell below the 19,700 level. Now at close, the market, let's talk about Sensex first. Sensex was up about 0.5% at 65,832 levels, whereas Nifty surged about 0.59%, sitting just above the 19,638 levels. Now broader markets, Shweta, continued their outperformance. Both Nifty Mid Cap 100 and the Small Cap 100 indices were up about 1% in today's trade. They have been outperforming, as we have been talking about for probably the last few months or so. The outperformance continues, and both the indices gained about 1% today. We also saw a sharp decline in the volatility today. India VIX was down almost 11%. In the morning it was down about 4%. The volatility continued to reduce since we are coming off from the monthly FNO expiry, which was yesterday. So the volatility index today dropped about 10.68%, and it currently sits at about 11.45.
Gaurang Shah joining us on the show at this point. Gaurang, thanks very much for taking time out. Good afternoon. What are you making of market moving in the positive terrain today? Is this a positive cue? Is the worst behind? What should we pick up?
Thank you, Shweta, for having me on the show, and good evening to all of you all. So I guess the entire week, that we saw, and the week that we saw last, we have seen a sizable amount of correction from 20,200 to almost about 19,550 or thereabouts. Don't know exactly what the low number was, but I believe it was close to that. So in terms of percentage, if you go to see, we did lose quite a bit of ground. Given the fact that this week we had the FNO expiry, monthly FNO expiry, choppiness and volatility was the order of the day, and we had given out our view on the market this Monday morning, this week on Monday morning, that we could expect choppiness and volatility. And that's what exactly followed. I think large part of the correction that we had to witness is already done and dusted. We could possibly see some stable ground next week, but next week we have a truncated week. On 2nd of October, we have an off. Monday will be an off. We'll get back to trade on Tuesday morning. Expect some stability. And my understanding, Shweta, is that if we give a decisive close and stay above 19,700 on the Nifty spot, then possibly march towards 19,800, 850 would come rather sooner rather than later. And of course, we will also have the curtain raiser for second quarter earnings. Hope that should give some kind of wind and direction to the market.
Now, Gaurang, you expect some sort of stability kicking in next week, but I mean, this week, the entire week, we saw markets were they started the week on a flattish note, then they turned extremely choppy. One day we are seeing a 1% rise in Nifty, the next day we are seeing a 1% fall, another day we are seeing another 1% rise. Now, is it all domestic, global cues, or are there any domestic cues that are also weighing on the sentiment?
Domestically, I don't see anything wrong, Suyash, other than, of course, the factors that we already discussed earlier also. That is crude oil prices above $90, 83 levels and above as far as the rupee dollar equation is concerned. And of course, little bit of deficit on the monsoon is what was kind of concerning the market. Point number one. Point number two, we also discussed the levels that we've seen from 1st of September till date. 1st September 19,260, 15th September 20,200, and then eventually we saw levels of 19,550 very recently. And during this entire month starting 1st of September, what data I have, Suyash, is that the FIs were net sellers. But on the flip side, we had domestic institution buying a little bit more than what the FIs had to sell. So we have found a little bit of stability, and whenever markets have gone to the highest level and made an all-time high, choppiness, volatility is the order of the day, especially when you are in the week of FN expiry.
Now, as you said that you expect some sort of stability next week, perhaps the focus will shift towards the earnings season, which again starts in the next couple of weeks or so. Is that how, am I reading your thoughts correctly?
So I think it's going to be more, well, first of all, on the earnings front, we at Geojit believe there could be a little bit of better shade than what we've seen in the second quarter. Sectorally, company-specific numbers, and of course, a dissection of those numbers as to whether they are in line, better in line, or below the weather will possibly give direction. But in terms of the market correction, that is Sensex and Nifty, and of course, expecting that there is no huge negative news flow from the global front, we should stabilize a little bit. Our view is that financials, that is banking as well as NBFCs, along with autos and FMCG companies, should deliver better numbers. Defense, power generation and distribution, and of course railway stocks will continue to be in the spotlight.
Now, interesting that you picked FMCG as one of the sectors to outperform. Now, in Q1, we saw that, at least in the FMCG pack, there was an expansion in the margins across the board. But with inflation continuously running hot and, crude threatening to break past that 100-barrel mark, do you expect some sort of pressures as far as profit margins are concerned?
Well, first of all, if you look, we look at things from the fundamental point of view. And if you're looking at it from a long-term time horizon, India was, is, and will always remain a consumption-driven story. This week itself, we did see a couple of FMCG big boys perform quite well, likes of Hindustan Unilever, Colgate, etc. Just to name a few names. Monsoon impact, though it was a little bit scary in the beginning of the monsoon season, but I was reading a report yesterday which says that the deficit, now that slowly and steadily there is withdrawal of monsoon season, the overall deficit pan-India is somewhere close to about 5% or below that. And there are some days of monsoon left by the time we say goodbye to the monsoon season, to the rainy season. So the demand factor from semi-urban and rural India will continue to be a great contributor. Remains to be seen what the numbers are. The other concern for the FMCG pack was the input cost. The crude oil being at an elevated level is a concern, but other than that, there is raw material cost also that we have to take into consideration, and that has eased off a little bit. So we believe that the volumes and margins could stay intact. Company specific, it will all depend upon where does the number go in terms of promos and ad spends. I think that is what one will have to watch out for.
Gaurang, the margins were relatively higher in the first quarter. Do you expect the same sort of margins in the second quarter as well, given that input cost, as you mentioned, could be worrying given higher crude oil prices, and that could impact perhaps the margins? And also with festive season around the corner, do you expect companies to cut cost, FMCG companies?
I don't think cost cutting would be something that the companies will do in a time when you have multiple months of festive season, Shweta. So my sense is that, yeah, discounts might be there in terms of offerings, depending upon what category and which product does the discount go to and how much does it take off the shelf. But spending is always something that was in the forefront in India. In times of inflation being high, you may end up spending a little bit lower and going for the second product, not the top one. But you are definitely going to spend. I mean, that's what our view is. So margins may take a little bit of squeeze, but it's not going to have any huge impact. And our belief is also, Shweta, that operating efficiencies would definitely be put in place by the respective management.
Now, Gaurang, the number of unique investors in Indian markets have surpassed 8 crore mark, and the retail participation is also at I think around a 2-year high or so. Now, in light of the extreme volatility that we have seen in the past couple of weeks, what will be your advice to the retail investors? How should they navigate the market at this point in time?
Well, so firstly, if you're coming directly to the equity market and investing through your financial advisor or by doing your own homework, don't try to rush into the market. Be disciplined. Invest in a staggered manner. Don't venture out into broader markets if you really don't understand them, especially in the small cap universe. You may end up burning your finger and not having a very pleasant experience investing in the stock market. Mid caps sectorally you should pick, and large cap is something that should be always preferred. And I always mention to us that buy quality, don't buy quantity. And with the kind of recent correction that we had in the small and the mid cap universe, you remember almost 2.75% crack on the mid cap, 3% crack on the small cap, has left retail investors with a little bit of injured feeling. So you need to be careful. But large cap is something that you always prefer. And if you are doing through mutual fund SIPs, for the love of God, don't stop your SIPs because of volatility.
So words of wisdom from Gaurang there. Invest in a staggered manner. Don't put your all the chips in one basket. Perhaps move towards large caps instead of.
And keep your mutual funds going.
Keep your mutual funds going through SIP, that too.
All right. And let's also quickly take a look at the sectors we are tracking.
Certainly, Shweta. So among the sectors today, the pharma pack was the best performing sector on the NSE. The pharma pack, I think Nifty Pharma was up about over 2.5%. Now there was a fair bit of positive news coming in for the pharma pack. There was a report that I was reading earlier in the day that the patent protected a lot of patent drugs in the US, they have on which the patents has expired. They have not seen a lot of competition emerging, and even if there is competition, not too many large players. So there's a big gap in the generic segment, which could perhaps bode well for India's generic companies. There are a lot of generic brands that in the Indian market. And IT was the underperformer today. In fact, it was the only sector which ended with losses today. It was on about 0.3%, and we saw correction across the board in the IT stocks. Now this was on the back of a muted guidance from Accenture. Now Accenture expects revenue to rise about 2.2 to 5% in the next quarter across the board. The expectation is that given that the inflation is high, and the expectation is that the interest rates will also continue to remain elevated for longer, and perhaps there could be another rate hike in the offing when November rolls around. So all this could bode negatively for the IT pack as demand will reduce. Now, as we know, Indian IT companies are highly exposed to the US market. They get a lot of their orders from the US market. So elevated levels of interest rates, as well as high inflation will continue to be a pain point for IT companies, and as a result we saw some correction in there. Now,
in fact, services exports have also taken a hit from the latest data that has emerged out of balance of payments. We know that services exports is not doing too well for India. At least that's the number that's coming in for the first quarter of the year.
That is obviously there, and if you see, the rupee has also been under pressure, Shweta. So perhaps, you know, if the exports
that's
are
a double
there,
whammy.
Double whammy, because you know whatever you are making, you're making little in the first place, and whatever you're making is getting eroded by the exchange fluctuations that we are seeing.
All right.
So let's get back to the sectors today. Now, PSU banks, metals and media stocks were also in action today. All three indices were up 1.5% to about 2%. Now, for the metal pack, perhaps the trigger is that crude prices have softened,
right.
and so the commodity prices overall will also soften, and perhaps production will also pick up.
All right. So those, of course, are sectoral wisdom that we are getting from Suyash at this point. But on Nifty IT, I want to understand from you, Gaurang, is there going to be a likely pickup in perhaps next 6 to 8 months? What is your view on the IT pack?
So, Shweta, we definitely believe so. I mean, we have remained positive on IT when large part of the market participants were underweight last year. This year also there are a little bit of concern. And taking cues from what Accenture did is something that you will do, but I would not completely ape what Accenture has done into Indian IT companies. And there is tremendous amount of opportunity, Shweta, with respect to IT, cyber security, different services and products, and of course, not to forget, after the first quarter earnings, couple of IT companies have announced some large deals. I'm not saying that will translate into revenue immediately in this quarter, second quarter. It will take time. But if you're not looking at short to medium term, and if you're looking at, say, a year and a half plus or 2 years kind of time horizon, then my advice would be that please make IT sector a small part of your overall portfolio.
Now, Gaurang, also want to get your take on the pharma pack. Now, we saw across the board buying in pharma. Now, the report that I mentioned earlier in the conversation was that it will be the patent expiring in the US will be positive for the generic segment. But why are we seeing buying across the board in the pharma pack?
So, in times of uncertainty and choppiness and volatility, there has always been flight to safety towards pharma, and I'm sure all of us remember post a little bit of withdrawal symptoms on the pandemic front, which was an unpleasant gift from China. Pharma did hog the limelight for almost about a year and a half or maybe more. Our sense is that pharma will always play or will be in the spotlight whenever we have choppiness, volatility, uncertainty. So as a brokerage house, we like couple of pharma names. To name maybe 3 or 4 of them: Sun Pharma, Dr. Reddy's, Divi's Laboratories, and Cipla. But Suyash, the other problem with pharma is that suddenly one fine morning you realize that the US FDA has given out Form 483 objections in the EIR or any other red flags, and that leads to a little bit of pain spilling all over the entire pharma sector. So that's something that needs to be taken care of.
Now, Gaurang, interestingly, you were talking about US FDA. Now, there was a report also today which suggested that US FDA will step up unannounced inspection, and given that, how sensitive these pharma stocks are to US FDA inspection, whenever we hear any sort of news, the stocks react strongly. So, what do you make of this news?
I also, on the backgrounder of that, in fact, in the entire drug industry in India has come under increased scanner, not just of the US, but various other export destinations, especially in Africa as well, be it the cough syrup, be it the eye drop. On the back of such news items, I believe, how do you see the pharma industry or the pharma pack reacting?
So, Shweta and Suyash, there was a question asked to me on the pharma sector whether Indian pharmaceutical companies are getting victimized by the so-called US FDAs and other regulators in the world. The surprising part, Shweta and Shuyas, is that whichever company where there is a concern, whether it is good manufacturing practices or whether it is a Form 483 or whether it is a red flag in the establishment inspection report, none of these companies have objected to it. They have accepted that yes, there were shortcomings. So what I'm trying to say is in effect that India was, is and will always remain pharmacy to the world. And when you are in the business of making either APIs, generics, or life-saving drugs, you need, and if you are competing at an international level, then you need to do your job right. And you need to take appropriate steps so that there are no concerns like this which may arise in future.
Now, Gaurang, before we talk about the stocks that were in action today, one of the sectors that has also caught limelight is the paint sector. You know, a lot of movement happening there, and in fact, a lot of the stocks have come under pressure lately. Now, one of the reasons why the stocks are under pressure is, of course, that crude continues to, rise, and it's threatening to break past that $100 a barrel mark. And as we know, crude is an important raw material for the paint companies. Another factor that is perhaps weighing on the market, and maybe you can elaborate more on that, is the entry of Grasim and a potential entry by the JSW group in the segment. So in light of the the kind of tectonic shift that we are seeing in the industry, what's your overall view on the the paint stocks, and if one is to invest in paint stocks, what would be your preferred pick?
So we have coverage on 3 names in the paint universe: Asian Paints, Berger Paints, and Kansai Narolac. Some years back, there was an IPO called Indigo Paints, on which we had given a subscribe recommendation. Now, so you have to understand one thing: with paint companies, of course, like you rightly mentioned, large part of the input cost is oil-based. Most of the paint companies have long-term contracts as far as their requirement in terms of raw material as far as oil is concerned. If these contracts get renewed at a higher level, only then and then there is an impact on the margin front. And even if there is an impact on the margin front, in case if the contracts are renewed at higher price, then the paint companies very comfortably increase the prices of the end product that you and me buy from the market in form of paints. So you and me will have to bear the brunt of that, not the paint companies. We remain positive on that, on the paint sector, and we believe that whatever happens in the positivities as far as real estate sector is concerned translates to positivity to the paint sector also. And paint companies do not, and no, fact of the matter is that if you have a cement concrete wall in your house, you're not going to look at it with a lot of pleasantries. You will definitely paint it. You may not go in for a high-end paint, but you may finally go in for an entry-level paint. Decorative paints have been contributing to a great extent to the volumes and the bottom line. Industrial paint, automotive paints are something else that have been continuously contributing. Interior, exterior paints are also something that has been contributing. So, and of course, government spending on infrastructure, state level spending on infrastructure, private companies, corporate India going for capex, all these translate into positivity. Higher crude oil prices may have a short to medium term overhang, not indefinitely.
All right, and let's also quickly move on to some of the stocks that we are tracking, Suyash.
Yes, Shweta. So among the top gainers in the blue chips was Hindalco, which rallied about 5.6% or so. Now, there was no news trigger per se, but perhaps a softening in crude prices is boding well for the stock. And as a result, we saw a run up of about 5.6%. Now, Hindalco, if you remember, Shweta, is in the business of producing aluminium and copper, which require a significant amount of energy for production. So, a softening of crude prices will also lower the production cost for the company, and perhaps that's why we are seeing a 5% sort of a movement in the stock. NTPC was another one. NTPC surged over 3.5%. In fact, it ended about 3.78% higher today too, and the stock also hit a 52-week high. Now, this was on the back of the company commissioning a 800 megawatt power plant. After the news broke out, the ICICI Securities also issued a buy rating on the stock with a target price of about 300 rupees. And in fact, if we see the performance of NTPC in the last year or so, the stock has rallied about 45%. So good movement there in NTPC stock. Now, Dr. Reddy's was another one which rallied about 3% in today's trade. Now, the trigger for the stock was that it has incorporated a step down wholly owned subsidiary, and we are also seeing, you know, across the board buying in pharma packs, so perhaps that is boding well for Dr. Reddy's as well. Hero MotoCorp and Tata Motors were the two auto stocks that were in action today. Both stocks gained over 2.5%. Now moving on to the losers, Adani Enterprises was a top loser among the Nifty stocks. It fell about 2.4% in today's trade. Now there was news that we covered earlier in the morning also that you know, Abu Dhabi based IHC is planning to exit two of Adani group companies, which is Adani Green and Adani Energy Solutions. Now the news is that IHC is already in talks with a buyer. We don't know who the buyer is. We don't know at what price they'll exit the stock. So perhaps you know, losing a marquee investor like IHC is something that has kind of turned the sentiment negative for the entire Adani pack, because most of the stocks were trading with losses today. And as you can see, a lot of IT stocks feature in this list. LTI, Mindtree, Infosys, HCL Tech. Now, as we discussed that the decline in IT stocks was on the back of Accenture's muted guidance. Nestle India was another one which fell in today's trade. The stock was down about 0.4%.
All right, those of course are top gainers and losers for the day. Appreciate you, Suyash, as well as Gaurang Shah. Thank you very much, sir, for taking time out. Thank you for being with us this afternoon. Suyash, to you too. Thank you, gentlemen. Appreciate your time. Moving on, if you are wondering what broking firm Zerodha is valued at, co-founder Nitin Kamath has spilled the beans. The broking firm is valued at around 30,000 crore rupees or $3.6 billion, much lower than the market's guess estimates, according to Nitin Kamath, who's also, remember, the chief executive officer, and he wrote all of that in a post on formerly Twitter, now X. Zerodha is India's #1 brokerage by revenue and profitability. Kamath's clarification on the valuation came 2 days after the company released its earnings. Its profits surged 38% to 2,907 crore rupees in financial year 23. So a lot happening there. My colleague Krishna Kumar joining us here in the studio. Krishna, Zerodha's co-founder coming out and saying, well, do not inflate our valuation. We do not believe in notional values. Actual value is 30,000 crores.
Right. And in a sense, I would say everybody should take a leaf out of Zerodha's book. They've already been a company, who are setting an example in many ways. And here you have the founder of a company this big, one of the best growing companies, saying that, and in a sense, putting things into perspective. Even if you talk about their latest financial results, their growth has been lesser than the same time in the previous year. So he's talking about the fact that this growth will go up and down, and since we are in the capital markets are cyclical. You will go up. They're saying, he literally says, once government circular can make their business go down by 50% or up by 50%. That's the kind of volatility that you're going to be dealing with when you're working in the stock markets. You're a stock markets based business. So Mr. Kamath essentially saying that since this is where we belong, the chances of volatility are high. Yes, we've grown very quickly so far already, but doesn't mean that we're going to keep growing at this rate all the time going forward. In fact, he's quoted that growth rate that is ideal for them, which is around 10 to 15%. That's how much Mr. Kamath believes that the company should be ideally growing at, and he's got a point there. He's saying that the strategy of the company right now is not to look at valuations, because they're not interested in valuation. They want to grow their core business, and to do that, they've got to retain customers and got to retain their trust as well. And for that, they're saying no spams, no pushing customers to invest more than they would like to, no sales targets, no revenue targets. So in a sense, this is a great example, at least to my mind, that a fast-growing startups founder is setting by rationalizing essentially the kind of business that they're involved in.
All right, rationalizing business, having reasonable expectations of what is expected out of that brokerage firm. Remember, as I said, it is one of the best growing in terms of numbers and figures when it comes to revenues, one of the biggest brokerage firms in India, and has in fact scripted a story of success as far as Indian startups is concerned. But moving on, BMW iX1 electric SUV has been launched in India with a starting price of 66 lakh rupees, to be precise, 66 lakh or 66.9 lakh 90,000 rupees there. An extension, in fact, of the best-selling model of BMW X1. The new model has not only received a new life, but has also become the brand-only model to have petrol, diesel and electric powertrains. Sold out on the day it was announced and launched.
Right. Only that they haven't given out the numbers as in how many BMW iX1, the particular electric model that they've launched for this particular on Thursday, that is, and they haven't given out the numbers. But yes, they have been sold out. You're talking about this electric car. The latest from BMW, Shweta, it can go from 0 to 100 kilometers in just 5.6 seconds. And on a single charge, it can go as long as 440 kilometers. And it can go from 10% charge to 80% charge in just 20 minutes. And if you charge it for just 10 minutes, you can take it up to 120 kilometers on just a 10 minutes worth of charge. So it's a extreme...
The only caveat that it's priced at 67 lakh rupees.
Right.
That is ex-showroom.
Right. Look, talk about your average, these days I was about to say sedan, but this is your average SUV, your mid-size SUV, and the electric version. So you know the price differential is already around 30% between your petrol/diesel to your electric cars. And BMW, had its cars starting around 50 lakh rupees in India.
Right.
Let's put it into perspective. 70 lakh rupees sounds like a lot of money, but BMW's cars in India started around 49 to 50 lakh rupees. From that perspective, 70 lakh rupees, you would say, is a decent price point to launch their most advanced electric variant. And no wonder at that price point it's getting lapped up. So who am I to say anything? Maybe I'm not the one buying, but tons out there who think for nearly 67 lakh rupees that this car is absolutely worth it. It's BMW and it's electric. You know, they've got the show-off value of a BMW. At the same time, they're being responsible, eco-friendly by driving an electric car.
Okay, and if you're buying an electric car and you want to buy BMW iX1, it is, but only that it's been sold out for the year. Is that what they're saying, Krishna? To clarify, they've sold out for the year.
Good point that you make, Shweta. This is sold out as in sold out for the year 2023, which means that if you need to for deliveries starting 2024, you will have to go for fresh bookings. For now, they can't take any fresh bookings because they're sold out for deliveries till the end of 2023.
All right, so they've sold out till the end of 2023. Fresh deliveries will start in 2024, but remember, if you've registered, if you're hoping to buy one, October is the date you will get that BMW. If only you have that much money. I mean, for now you have to wait for 2024.
Or if you're one of those who has contributed to it being sold out by booking it in the first place on day one.
Absolutely.
In a matter of hours. Actually, the fact of the matter is that in a matter of hours it was sold out.
Okay, for those who have booked it, we'll get it in October. But another thing will happen in October. Starting 1st of October, the tax structure will change. What does this mean? This means that you will pay more on various kinds of foreign spending, including international tour packages, foreign travel for medical treatment, businesses, pilgrimage, and more. Higher TCS or tax collected at source rates will apply. The hike will also apply to personal gifts, donations, investments and family donations. Now, after a delay of almost 3 months, the higher rate of TCS at 20% on foreign remittances will kick in from 1st of October, which is a Sunday. The government has announced raising TCS, remember, from 5% to 20% on foreign remittances under the liberalized remittance scheme or LRS in May of this year. Higher TCS rates will apply on various kinds of foreign spending, which will also include your tour packages and foreign travel for medical treatment as well as for studies. The hike will apply, as I said, to everything that you are going to do out there, which is personal in nature, but also lots of changes. I'm told Gori Chadha, who's a tax expert, joining us. Gori is here with us. Gori, thank you so much for taking time out. Explain to us what happens. So if I go out, if I go abroad on a foreign tour and travel package, how much rate was I paying up until today, and how much will I have to pay starting 1st of October?
See, the thing is then, that when you travel abroad and you buy a tour package, so this does not apply if you are buying your tickets yourself, you are booking hotels and everything on your own. If you are buying a tour package, then earlier there was 5% TCS without any threshold, but now till 7 lakhs it is 5%, and after that it is 20%. So 20% is a very big amount, it's huge. So basically, if you are basically buying a package of 10 lakhs, you have to pay 20% on the, above 7 lakhs. So it's a very huge amount. But the thing is, the people who are going abroad for they are buying tour package or remitting money abroad, they think that this is basically tax which they have to pay. But the fact is that this is not exactly the tax which they have to pay. This is the TCS which is collected on their behalf, deposited to the government on their behalf, and later on they can claim the credit of the same amount. So when they file their return and when they are paying the tax, this amount which they have already paid as TCS will be deducted from the actual tax payable. So basically they are blocking their capital for some time. So I feel, of course, it's blocking your capital for some time, and it will hinder your working capital, but eventually you will get a credit. So I think that it is kind of an advance tax where you have paid tax in advance and later on you can claim benefit. But of course 20% is a very big amount. 5% was still fair enough, but 20% I think it's a very big amount.
All right, and what's the rationale for a 20% tax? I mean, 5% was already applicable on spending over 7 lakh rupees. Spending under 7 lakh is still tax-free. There is no TCS. So why change it from, like, what's the rationale you can think of the government had in mind to change it from 5% to 28%? Was it to shore up enough tax and then have enough money in your kitty, and then because you can get it back, as you rightly pointed out, you can get it back if there is a mismatch between your taxable income and how much you've already paid as an advance tax. What's the rationale behind this?
First of all, for TCS, what I understand is that the government wants to target the people who are spending a lot of money on luxury items like luxury cars, travel abroad, and spending a lot of money there. And in their income tax return, they are not showing any as such major income. So to keep an eye on them, that they are actually declaring that income in the return also, they introduced TCS. This is my understanding. Now even 5% TCS was doing the same job, and 20% TCS is also doing the same job. So I don't understand why they have increased from 5% to 20%, but I do understand that 20% will give more revenue to the government initially. So suppose if I travel in April 24, so my TCS will be deducted in April 24, whereas when I will file the return, that will be in July 25, I will claim that credit at that time. So for more than 1 year, my tax amount is blocked. It is already deposited in the government's kitty.
Right.
So this is the thing, that they are getting higher tax earlier. Plus, the concept remains the same, that they want to target the people who are not showing enough income in their income tax returns, but spending huge amounts on luxury items like cars and travel, and
Right. Okay. I think a 5% could have done the job. But on top of that,
Exactly.
Krishna, come to think of it, you're just blocking that money with the government. You're parking that money with the government for a year.
Yeah.
You're giving interest-free loan to the government.
Wait, apart from the complications of actually filing this tax and ensuring that the government ensures that you collect it from us and all the complications that it involves, there is a very specific impact over here, Shweta. We were talking about foreign travel. Foreign travel agents, for that matter, are absolutely devastated with this entire, the percentage of tax. They're saying that nothing else gets taxed at 20%. If your aim was to, sort of track foreign spends by Indians abroad, you can just lay, their suggestion is that you can lay a 2.5% mandatory tax on all foreign spends of people who have valid PAN cards. That way you can track people with PAN cards, Indian PAN cards, who've gone out of India and spent money and come back if that was your intention. This, like you're talking about, you're after a point parking money with the government It's this complicated process in terms of everything to track down taxes, which credit card, which bank, etc., etc. The complication of identifying what is the tax liability of an individual. Those issues have also been mentioned. The Travel Agent Federation of India, in fact, has 1,400 members across the country. So for travel agents, this is a death blow, so to speak, because it's an industry that's just recovering and emerging from the COVID pandemic, where it was absolutely flattened. So, in a sense, TCS comes as a huge blow, specifically for the travel agent industry.
Absolutely.
And the travel industry, Shweta.
All right, and before we move on, Gori, if I want to save this tax and I don't want to park this tax with the government, essentially, I should book my own travel, not go through a travel agent. Is that what comes out of this?
Of course. Whereas travel is concerned, if you're buying a tour package, only then this TCS is applicable. If you're booking your own travel, you're booking your flights separately, hotels separately, other places, you're buying the tickets on your own, and everything you're doing on your own, it is not a tour package, then of course this won't be applicable. But if you are buying a full package, then of course you'll have to pay TCS.
And one last clarification before we move on to another story, and I want you to stay back. What happens if I use my credit card? Because initially there were reports that credit card spends will also be taxed. That was clarified. So credit card spends are out of the TCS ambit?
Yeah, so initially the government said, the way they presented it was looking like that credit cards will also be liable for the TCS, but then later on they clarified that credit cards are out of the ambit of this new provision. As of now, credit cards are out of it, but of course, you never know in future if they again bring credit card in the same ambit.
Okay, so you never know. A lot of flip-flop that has happened already on TCS. But Gori, stay with us. Since you were talking about spending and we are tracking spendings here, are Indians spending more and saving less? And is that a good thing? That's the question we are asking. At least the data suggests that there is a shift from largely savings population to people who are spending dangerously beyond capability to pay back. Credit card spending in India has hit a record high of 1.5 lakh crores in August. Now, Indian households' net financial savings have also hit a 47-year low as household borrowings exceeds investments and traditional savings. So, people are spending less. They are spending more, saving less and less with each passing year. But what's problematic is that they're spending beyond their means. So the defaults are also rising. In fact, both credit card and unsecured loan defaults have risen by 0.6% and 1.5%. Gori, we are talking about a change in consumer behavior, and a change in consumer behavior to a point where it's becoming dangerous. As Indians, and this is what the data suggests, that we are saving less and less with each passing year. And not just buying, but buying to a point which is beyond our ability to pay back.
Yeah, see, there's a rule of credit card which says that you should use your credit card only to spend a fixed amount of money which you already have in your bank account, which you can actually pay back. So if you don't have that money in your bank account, you should not use your credit card, because otherwise people keep using credit card thinking that we will somehow repay it and then they'll default. And once you default the payment of your credit card, of course we know that the interest is really high. Secondly, I would say that, when spending pattern is increasing, I think it's good for the economy, because people will spend and it will contribute to the GDP of the economy. But at the same time, of course, saving is important. And as a advisor, as a portfolio management advisor, I would say that, everyone should understand that there are different categories of spending. You should categorize your monthly income into needs, wants, necessities and everything, and then plan how much you actually need to spend on the necessities, wants, and then how much you can save. So if you follow the rule of finance, then I think at least 10 to 20% of your income you will end up saving. But yes, of course, if you are just blindly using your credit cards and not thinking that how much money is there in your bank account or how much paying capacity you have, of course you will end up in a huge debt and crisis in future. So of course, I think the country needs more of financial education, financial literacy in terms of how to spend, how much to spend, where to spend, how to save, where to invest. In fact, saving and investing are two different things. I think not only saving, you should invest the money so that you can at least beat the inflation and earn something on that, rather than keeping the same amount in your savings account and earning hardly 3.5% or 4% interest, whereas the inflation rate is higher than that. Average inflation rate is 6 to 7% maybe sometimes. So yeah, so I think you should invest the money properly, and then you should let your money compound for your future, for your retirement, for your any other goal, buying your house, or maybe education of your children, or any kind of goal you have in your life.
Right, and words of wisdom coming in there from Gori. Divide your expenses on the basis of needs and wants. Have to draw a line between spending and saving. Not a very good characteristic there as far as, or not a very good trend there, but it's good for economy as it drives more consumption. However, it's also important to have enough in your bank balance for a rainy day, and we continue to bring you all those investment advice every day in the morning and in the evening. But Gori, thank you so much for joining in. Thank you for your words of wisdom. We'll come back to you as and when we can. And before we close this bulletin, remember the last date for depositing your 2000 rupee note in banks or to exchange them is 30th of September. So you have just one more day left to exchange notes if you haven't done so already. Remember, RBI had announced on 19th of May that 2000 rupee notes will no longer be in circulation. They will no longer be legal tender. After that, 4 months were given to exchange these notes or deposit them in the bank. According to RBI, 2000 rupee notes worth 24,000 crore rupees have still not arrived in the bank just as yet. So if you're holding on to that note, tomorrow is the last date. Krishna, do you have any of them?
Well, Shweta, I don't have any of them, but what I am hearing right now is that there are reports out in the media that that deadline could be extended by another month.
Okay.
So there are reports now coming in that the government is likely to extend that deadline from the 30th of September to the 31st of October. There's a possibility. There's no confirmation on that. Let me put it out over there. I've just been reading some reports online, so we don't know. For now, as things stand, September 30th is the last date. I don't have any 2000 rupee notes. Not even one of them. Of all the 24,000 crore rupee worth of 2000 rupees,
not a note.
Not even 2,000 rupees are with me.
Not a single note with Krishna, not a single note with me as well. But if you're holding on to them, remember, 30th of September is the last date. So far, there's no confirmation on whether there's going to be an extension. So far, stick to that date. Go exchange that note if you hold on to any of it. But with that, it's a wrap on this edition. Thank you so much for watching.
When a patient's mother touches my feet, begging to save her child's life, I don't feel empowered. I feel humiliated.
To normal people, the doctor is somewhere in between us and the God.
I'm just an instrument in the hands of God.
What you have initiated in making healthcare affordable to Indians.
India will become the first country in the world to dissociate healthcare from affluence.
To do the right thing, there's only one reason needed, which is intent.
We are pieces to solve all the problems. Someone has to put it together. This is the story of India.
Duologue with Barun Das featuring Dr. Devi Shetty. World premiere on Connected TV. Tonight at 10. Only on News9 Live. India's first and only digital exclusive English news stream for Connected TV. Powered by Tata 1mg Labs. Supported by Alliance Broadband.
They are the apple of someone's eye, holding the kiwi to our heart. We go bananas for them because it takes two to mango. Well, they are just perfect. But these bigger, juicier staples are sensing a looming crisis.
About 820 million people in the world don't get enough to eat every day.
As severe malnutrition and the risk of waterborne disease collide.
Their nutritional content has not been keeping pace.
Malnutrition among children below 5 years old has worsened.
Families struggle to feed.
Is our food becoming less nutritious?
Human bodies need a certain amount of nutrition to survive, and we can only eat so much in a day.
Why do we still have millions of people going hungry?
What we're facing right now is unprecedented perfect storm within a perfect storm.
Biotechnology is driving a transformation in human health.
जैसा अन्न होता है, वैसा ही हमारा मानसिक और बौद्धिक विकास भी होता है.
Accelerating a nutritional moonshot to grow the healthiest food.
Food be thy medicine and medicine be thy food.
And driving the taste of the future.
जय जवान, जय किसान, जय विज्ञान, जय अनुसंधान.
Our body needs fuel to do everything it must do. That fuel, of course, comes from food, and almost all of food we eat comes from the soil. One of the most important jobs is transforming nutrients. But over the past 70 years, they have been dropping.
The soil is being damaged and there's not enough nutrition which is coming from the soil.
What is causing damage to the soil? Intensive agriculture, using excess of water, use of synthetic fertilizers, use of pesticides.
Studies have shown we are seeing a decrease in the nutrient content in the crops.
Fruits, vegetables and grains grown today carry less protein, calcium, phosphorus, iron, riboflavin and vitamin C. But the roots of malnourishment have deeper roots. In drought-ravaged Kenya, crops have dried up and hunger is growing.
Shocking images of malnourished children are becoming commonplace.
The livestock are dying. Every second, an additional person is on the verge of starvation.
As rains fail for the fourth consecutive year, a famine is increasingly likely.
We knew that we were facing a catastrophe, but we failed to act,
placing 22 million people on the brink of starvation.
Children below the age of 5 and lactating mothers are the most affected.
Suffering like this should not happen to any child.
As millions are caught in hunger, thirst and disease crisis, the human conflict too has deepened global food insecurity. The emerging crisis in Europe is pushing wheat importing nations to famine.
Ethiopia is on the brink of famine. This is a problem not only of rising food prices, but also of a physical shortage of food.
Trapping around 25 million tons of corn and wheat inside the country.
As it is known, about 1/3 of the world wheat production is carried out by Russia and Ukraine.
First of all, it is impossible to sell grains and there is no money to fix it. There is nowhere to export, no sale of grain.
Far from the front lines, Africans feel the conflict's impact in wrenching food and fuel prices.
We hardly produce anything. We are totally dependent on international supplies.
The cost of production, it has increased immensely.
The amount we paid for 2 loaves of bread is now enough only for 1.
The menace of malnutrition has deepened since 2020. The pandemic was creating a perfect storm of problems.
आज रात 12 बजे से पूरे देश में संपूर्ण लॉकडाउन होने जा रहा है.
Malnutrition continued to haunt India. The country slipped 6 ranks in the Global Hunger Index.
The ranking of India, that's not a happy situation. We have stunting of children and then we have overweight.
While governments may question the integrity of such reports, an unconventional food crisis has engulfed the world, sending prices soaring, heightening illnesses, and much worse, starvation.
We do not know how much we are consuming, what we should consume, how much nutrition we are taking on daily basis.
While pressure continues to loom, scientific approaches offer the key to human sustenance. The emergence of genome editing is driving a biotech revolution.
Every species on this planet Earth has something called as a DNA.
Also known as the genetic scissors, it makes precise edits to the genomes.
CRISPR is a very fascinating tool. You figure out a part of the DNA sequence and create a guide, and then you link this Cas enzyme to do that cut.
The ease of use is rewriting the code of life.
We know more about our crop plants, the genes, their proteins, and the carbohydrates, and how they work, and then we are able to improve that.
Promising limitless potential to fight terminal diseases.
CRISPR could help rid us of diseases like cystic fibrosis, muscular dystrophy, and even HIV and cancer. Think about that.
Its inventors, Emmanuel Charpentier and Jennifer Doudna, won a Nobel Prize in 2020.
For the first time, the Nobel Prize in Chemistry was awarded to 2 women. Future of disease is gene editing.
The crops are being improved to provide a denser nutritional profile.
There is a way we can breed varieties with better nutrition, higher nutrition, and these varieties are called biofortified crop varieties.
This means we can gain more nutrition with the exact amounts of food.
If you're taking the right amount of food in right quantity, then you would be disease-free.
Improving gut health and absorption of nutrients.
Genome editing, as they're called, is also helping us to improve the quality of nutrients.
From movie theater popcorn to deep